So I've developed a financial model, a visual model that helps you plan and manage your finances better, and let me describe it to you. Effectively, it starts as a bottom line with a financial expression of what your goals are. So if you can imagine your life has a cost, and period by period, so month by month or year by year, that cost could change over time. It might increase with inflation, and of course we don't know how long you're going to live, but that becomes the base, the goal, if you like. Now above that flow of cash out, I imagine a liquidity bucket, a bucket of money that you can draw on to finance your expenses as they occur, and that would typically be your current account or bank account, that sort of thing. Now then, if we have some financial planning tools which allow me to show visually, as if you were looking into a crystal ball, what the balance in that account looks like as your life progresses over time. And the objective of a decent plan is one where you never run out of money in your lifetime. Now, the bucket itself of liquid cash is fed by various different things throughout your life, and I think of 6 different plans that generally contribute to that. The first would be your career plan. This would be where you have a flow of money in from your earnings over a period of time. Allied to that, you may well have a business plan. A business plan could draw on money from your liquidity bucket as you finance it. It should then start to pay you some dividends if it starts to become profitable, and of course you might be able to sell it at the end and raise some cash to put in your bucket that way. You may have a pension plan where you put money into a pension which draws that money out of your bucket, but later down the line it provides a benefit both in the form of perhaps a cash sum and also a lifetime income. Then you might finance investments and savings. They could draw money out of your bucket as you finance them, but again the properties and the shares and the various other investments you have could start to pay dividends, interest or rents as things go down the line, and of course they can be, you can plan to sell them as well. One part of everybody's plan, which often is just cash flow negative, is their contingency planning. This is where perhaps you might spend money on insurance premiums or having wills and powers of attorney, that sort of thing written. In your plan A, that's always going to be a negative number, but of course it can become cash flow positive in your contingency planning. And then finally we've got asset purchase and finance. This is where you raise money perhaps through mortgages or loans to purchase the finance of a house or an investment in a business or some other asset, and of course that will have cash flow consequences personally to you as well. Now the whole model is designed so that if you put all of those pieces together and we can look into the future, if you don't run out of money then we know you've got a robust plan.